Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues, Yee-Cent Wong, Co-Head of Europe, and John Hogan, Managing Director in our Ratings Legal team. In this episode, we'll be discussing the commercial real estate collateralized loan obligations, covering the content of our recently published report, European CRE CLOs, an emerging asset class. The report and related information can be found on kbra.com. Commercial real estate financing in Europe is traditionally a heavily banked and private lending market. However, recently the market introduced a new platform, providing another option for borrowers and investors. This latest evolution, commercial real estate collateralized loan obligations, or CRE CLOs as they are known, already represents a significant market in the US capital markets. In October 2021, KBRA rated the first widely distributed CRE CLO transaction since the global financial crisis, called STARS Mortgage Securities 2021-1, which was sold to investors with both euro and sterling tranches. Since that initial transaction, KBRA has received numerous inquiries from investors, banks, and lenders about the asset class, seeking information about the prospects for the development of a European CRE CLO market. So we wrote a report covering the topic and how the asset class developed in the US and how it compares to European commercial mortgage-backed securities and the recent STARS transaction. Today, I'm joined by Yee and John, where we will take a look at the CRE CLO market and how it works and explain in greater detail what you can find in the report. Many thanks for joining me, Yee and John. Let's start with the basics. So what is a CRE CLO? I know we only have the one transaction that classed as one in Europe at the moment, but taking the well-developed US market as a reference, what really defines a CRE CLO?
Thanks, Gordon. It's the transitional nature of the collateral and the transaction structure that defines a CRE CLO.
And in terms of structure, I guess there are probably two high-level points. So first, you have the flexibility afforded to the sponsor, typically the originator of the securitized loans. So subject to various conditions, the sponsor can modify loans, sell loans, and in some cases, reinvest principal proceeds to buy new loans. And of course, these are all things that can change the composition or profile of the portfolio. The second point is the use of structural features that might be more familiar to CLO investors than CMBS investors. So what I'm referring to here is the use in CRE CLOs of interest coverage, or IC tests, and par value, or OC tests. We'll come back to these, but basically they provide some protection to the senior notes in a CRE CLO.
There's also a difference to the way this transaction sponsors treat the structure. CRE CLO sponsors typically hold the junior classes and use securitization for financing purposes, so there's an alignment of interest. For example, the sponsors for the STARS transaction held 20% of the subordinate tranches, while sponsors for US CRE CLOs rated by KBRA in 2021 held 15 to 25%. This is in contrast to traditional European CMBS, where all but 5% is typically held by investors, and the retention amount is generally through a vertical slice of the transaction. Given the relatively large percentage of subordinate notes held by CRE CLO transaction sponsors, the ICOC test helps to incentivize the sponsor to ensure performance of the transaction.
Great. So when it comes to the US CRE CLO market, there are varying elements of CRE CLOs, such as the manager flexibility and collateral types. Do you think you could outline these to give us a better idea of the broader span of the CRE CLO market?
Absolutely. So in terms of manager flexibility, we see three broad categories. First, you have the static transactions, where there's typically no ability to reinvest loan repayments, and instead, those principal proceeds are used to pay down the notes. Then, lightly managed transactions, where the sponsor can reinvest principal proceeds, but does so by adding exposure to loans that are already in the portfolio. And finally, you have managed transactions, where the sponsor has additional flexibility because it can use principal proceeds to purchase entirely new loans that are not already in the portfolio. You can draw a similar set of distinctions with respect to ramp-up periods. So while static transactions are typically fully ramped on closing, a lightly managed transaction might have a defined ramp-up period for the sponsor to acquire pre-identified loans. While in a managed deal, the sponsor can ramp the portfolio without being limited to that set of pre-identified loans.
In terms of the types of collateral, it can include the same types of properties as a traditional CMBS transaction. This would include multifamily, office, industrial, retail, and hotels. However, the collateral tends to be transitional for a number of reasons. It could be because occupancy is below market due to recent construction, ongoing renovations, tenant departures, or poor management, or higher rents could be achieved through renovations or turnover of existing tenants paying below market rents. The sponsor may also look to improve the operations of the property by reducing costs or changing management. In some cases, properties may be stabilized, but subject to a near-term event, such as a potential tenant rollover. In other instances, the loan may act as a bridge to the sale of a property or longer-term financing.
Thank you. I think that gives a good picture in terms of how a CRE CLO works, at least how it's developed in the US. But how does this really, in terms of for European investors, how does this differ to a European CMBS transaction?
Sure. The collateral tends to be stabilized for a traditional CMBS transaction, although there have been one or two deals in the past year that have had transitional collateral. And then the other major difference is that there's typically no flexibility for sponsors in CMBS transactions. They can't reinvest principal proceeds or modify performing loans, for example.
And if you wanted to pick out some other distinguishing features, there are some deals with two loans, but in the main, what we see in Europe are single borrower transactions, whereas CRE CLOs, on the other hand, have multiple borrowers. And the CMBS transactions in Europe, they essentially pay down principal on a pro rata basis, at least until a loan default, whereas CRE CLOs are either fully sequential or have a defined amount of pro rata amortization. Yee's already alluded to the differences in terms of alignment of interests or skin in the game. And of course, CMBS transactions don't include the CLO style structural features, the IC and OC tests.
Thank you for bringing that up. That is, as you highlighted towards the beginning, one of the key structural elements of a CRE CLO is those IC and OC tests. Can you maybe give us a bit more detail in terms of how these work and what they are truly for in terms of their role in the structure?
Definitely. The IC or interest coverage test is typically set at 1.2 times, and it's tripped if it falls below that number. For the STARS deal, for example, that it's calculated essentially based on the interest on the loans divided by the interest on the investment grade notes. But the numerator also includes servicer advancing and liquidity reserves less senior trust expenses. It's usually, as a result, harder to trip the IC test than the OC test.
And for the OC test or par value test, well, as the name suggests, it hinges on a calculation of the par value of the loans relative to the balance of the notes, typically the investment grade notes. That calculation will haircut the value of loans that are in distress or default, and the trigger level will be set below the day one par value ratio. So on the STARS transaction, it was 5 points lower than the initial par value ratio. That was actually also the average level of cushion we saw across the 15 CRE CLOs we rated in the US last year. All else being equal, a smaller cushion makes for a more sensitive trigger, which is more protective for the senior notes.
If either the IC or OC test trips interest from the subordinate notes, which is typically held by a securitization sponsor, is diverted to the senior note holders. This incentivizes the sponsor to make good decisions on behalf of the trust, both in terms of performing loan modifications and reinvestments.
Thank you very much, Yee and John. That was very informative. And just to sort of sum things up, we at KBRA view this market as one that may slowly develop and emerge within Europe, offering commercial real estate market a new source of funding. Capital markets in Europe have yet to really develop into a competitive commercial real estate lending space compared with the large volumes of CMBS and CRE CLOs that we see in the US. The majority of European commercial real estate financing tends to be done via banks and loan funds, with an increasing proportion financed through direct lenders and insurance company, thanks to the beneficial regulatory treatment on the insurance side. CRE CLOs in Europe do have the potential to open a source of funding for sponsors, as well as provide another option for investors with an interest in commercial real estate. The current market environment for European CMBS, which is showing signs of steady issuance and a regular investor demand, provides an opportunity for the start of the development of European CRE CLOs, competitive source of funding. It is, of course, not without its challenges. There's still plenty of education and work needed to progress the development of the market. However, with the one transaction in the market and the potential for more in the near term, the prospects for it are positive. The market will evolve, in our view, to include unique European characteristics in comparison to US CRE CLOs as more transaction sponsors enter into the market and the relationship between sponsors and investors evolves. Thank you very much for listening. We look forward to bringing you more conversations in European credit. And don't forget to check kbra.com for our latest ratings and research and for the CRE CLO report that we published earlier this month. We wish you all a prosperous 2022. Stay safe, and we will speak to you again soon.